Following up from the theoretical presentations and conceptual presentations, although, as Marx would say, the presentations were always about the real. Even when they're abstract and theoretical, they were also explaining the real world and some of the basic power structures behind them. I want to turn now more to some of the features of the current crisis. Particularly, I want to present some of the basic features. So it's going to expand some of the conceptual points, and then we can look at some of the specific features that occur that I've been unfolding. And so I want to speak to something that I'm going to use it in terms of what we often call stylized features or characteristics. So in other words, what are the basic features of this period, or how it's evolved over the last 30 years? And then we can kind of link in here and there some specific data, but I want to highlight mainly the underlying features. And so I'm going to lay out 3 or 4 main ideas, and then we can look at them a little bit more, and then start going into looking at the specifics of the crisis. So I want to begin by just going back to some of the basic structure of the financial market and its institutional structures, and then to get at some of the different characteristics of it in this period. From what Adam was doing, we could look at, Adam and Tom, we could look at money capital, or what we can call productive capital. We can also break it down into bank capital and speculative capital. So we can look at it in different forms, the different monetary forms it takes. And we can look at bank capital. We typically divide that into 2 forms. We speak about what Tom was calling interest-bearing capital, which essentially means banks. Banks in the most direct sense of giving loans to corporations. Okay? So in other words, they're earning interest on the money they advance to productive capital. We can also look at what we call money-dealing capital and its different forms. And then speculative capital, or what Adam was speaking about, is the capital that is dependent upon the future and trying to calculate the future all the time. And we mean by speculation something in 2 senses, right? 2 senses. One, speculative, that it's about the future, right? And you're trying to predict it all the time. And speculative in the more negative sense, in that it often just proliferates and takes on an additional risk and casino-like features, etc. So we're meaning speculation in both senses. It has something concrete to do with the future and the need to offload that risk. But because the future and everything contains so much uncertainty, it also has this aspect of proliferating on its own, right? Through particularly uncertain point in time. So we can then define these in terms of the financial sector and its dimensions a little bit more thoroughly. We can define interest-bearing capital in terms of basically what we can call commercial banks, or investment banks, or near banks, which are credit unions, and sometimes we'll also speak about government banks. We used to have in Ontario the Ontario Savings Trust, was it? I'm trying to remember. It was abolished by the Harris.
Ontario Savings
Branch, that's right.
They still have it now.
Yeah, and Alberta still has the Alberta Treasury branches, which are government deposit-taking institutions and then loan. In North America, we've largely abolished these, right? They don't exist anymore, but at one time they were a fairly important aspect of mobilizing savings and then using them particularly for government investments. What we also have then is what structures this relationship, right? These then are governed by central banks, okay, the Bank of Canada, the Federal Treasury, and so on. Also, different types of regulatory agencies will also govern over these. Security Exchange Commissions, or the Ontario Exchange Commission, and so on. The Deposit Insurance Commissions, and so on. There are different regulatory agencies of the state which will govern the financial sector. Over and above these, we then have their correlates in the international sector. The IMF, right? The Bank of International Settlements, and so on, right? They'll deal with different regulatory structures at the international level, including correlates to these regulatory agencies typically. Some sort of correlation between different national security agencies, national securities regulators will kind of also have correlates at the international level. These then also have a set of additional, typically private sector, right, checks and balances, supposedly. These will be things like rating agencies, right? Rating agencies like Moody's or Standard & Poor's are a few of them, and they then calculate whether on the financial solvency of the financial company they're assessing. We also have accounting standards, okay, which is assessing whether the regulatory structures and the rule keeping being set up by the companies is also fair in the reporting of the assets that they're holding and their liabilities. You'll also have the other that becomes important is insurance agencies, which are also doing a similar thing and then often underwriting a range of the activities of the financial markets. Okay? Now, these then have the correlate on the other side of the borrowers, right? The borrowers and the lenders, of course, I should say. These will be households, right? And then, of course, if we were looking at this more analytically or precisely in different places, we'd obviously want to know the class structure of those households and the way that they're borrowing and lending, because there'll be clearly huge differences in that. Also, then, we have the corporations and governments. These are the basic way you can kind of develop a schematic, right, of the financial sector. Okay? Those different kinds of institutions. Now, the other thing that becomes important is the way that we can then look at what we can call the hierarchy of money and the hierarchy of credit. Now, why we tend to synthesize the two is essentially different forms of credit are different forms of money. And you could even take holding a security these days, that is, a preferred share in a company, as a form of money because you're trading it so much and it's so liquid on stock exchanges, so you can convert it into money all the time. Right? So we typically put that also as a particular hierarchy of money. Now when we do that, you can look at this in two ways. You can look at it in two dimensions. Okay? You can, on the one hand, do it in terms of the different currencies that exist. There's one dimension of rating the hierarchy of money. At the top of this has been the dollar. Right? Below that has been the yen. Below that has been the euro. Below that has been sterling. And below that has basically been all the other currencies. Okay? So there forms a hierarchy in the relationship between money, right? And to some extent, these relationships are typically been anchored in something. Typically gold historically, sometimes gold and silver. For the post-war period up into the 1970s, it was what was called a gold exchange standard. Basically, the dollar was key, but you could take a dollar and exchange it for gold. Now, essentially, these are are just the relationship in how trustworthy you think each currency is in relationship to the other. And particularly then, with one currency being the anchor, and that being the dollar, has been the main anchor. But essentially, you're looking at the arbitrage, or relationships of risk, and assessment between these different currencies to form often what we call world money. Now, the US dollar forms the base marker in world money. That is, it's what most people are accepting as exchange for payment and exchange for other currencies in trade. But in a sense, because it's always now in relationship to these other currencies, essentially you're dealing with the creation of money partly through derivatives markets. Right? That is, world money is partly calculated by the continual calculation of how the dollar is doing in relationship to other currencies. Okay? Now we can look at the hierarchy of money in the other direction by the different forms it is. Obviously, to some extent, in fiat money, that is the actual currency, or what you have in cash or deposit in a bank. And then you can assess it in terms of the different way we can look at credit. The first one we usually put is what we call the Fed funds rate. Right? That's the rate by which the American Central Bank, the Federal Reserve, lends to the primary banks in the U.S. Okay, what we call the Federal Funds Reserves. The next is the T-bill, American Treasury bill. Okay? The next after that is all government bonds. Then we have corporate, what we call corporate paper. That is corporations lending bonds out, bonds and different short-term paper. Or then we have the long-term bond market. The long-term bond market. And then we can also look at equities yields. That is on stocks. We could also then put in derivatives markets. And some people would also put in gold as another marker in these forms of holding money. Essentially, you would then have an axis along this of the different countries and their parallel, right, of these different forms of money market instruments. Okay? So when we put these two together, we get the basic elements of the big, overwhelming world that is the financial markets. Right? That is a hierarchy of money between currencies, between places, and all the different forms it takes within different national places, in different countries. And then all the different kinds of financial institutions that exist, and basically you have correlates to these in every country. So if we just stop here, we can just kind of add a couple of points, and then think about what has been important to this period. And the credit bubble. First off, the thing I just want to come back to underline is in the contemporary period, what we're dealing with is pure credit money. Okay? Pure credit money. It's not backed by gold, right? Right? It has no commodity back in it. It depends upon, it's what we often we also use fiat. That is, it's dependent upon the government that's issuing it, right? For its underlying value as a currency, which then, as Adam was pointing out, its underlying value as a currency is then dependent upon the value that's being produced in that particular place. But clearly, when we have credit money, the relationship it can play relative to the value that's being produced, it can depart enormously. Right? Because you can continue to print money, right? These financial markets can grow enormously in terms of the claims on each other. So the relationship it holds, right, to the underlying production of value in the productive sector can become quite unlinked, right? Can separate a great deal. Okay. The second thing I just want to underline. The relationship of these currencies is now structured by what we call flexible exchange rates rather than fixed exchange rates. That is, for the entire history of the world, up until the last 30 or 40 years, the relationship between any two currencies tended to be fixed. That is, it was a fixed ratio that established the relationship between the two. Okay. By convention, or for much of the period by its relationship to gold, and then for the post-war period by a structure of fixed exchange rate established by the international institutions and the Bretton Woods systems. Now, the relationship between these currencies, and thus all these other forms of money, right, takes place in the context of flexible exchange rates. Which means you potentially, when you have any shift in value between two currencies, you're disrupting the financial markets completely between the two as well, right? Because all the arbitrage between interest rates and so on is shifting between the two. Right? So you have much more complexity there. The third thing is what Tom pointed out. When we have pure credit money, and flexible exchange rates, we're already moving in the direction of the state having less control over the currency that's being printed, right? That is, the creation of money starts being pushed more and more inside the private sector. Okay? And it can be, as Tom was saying, it can be just the control that the central banks exercise over private banks and how much they can issue currency in relationship to the reserves, which under the period of neoliberalism, we've given greater freedom in terms of reserve requirements for the banks to print more money. But it also can be from the deregulation that allows a whole range of other money-making forms of financial institutions to take hold. That is, they can multiply, and they can start lending credit in different ways. So we can therefore deal with a huge expansion of these financial instruments and these financial instruments. Okay? So this is stop and ask, okay, when we think about what's happened in the bubble, what's happened when we look at these two things? Clearly is underpinned by its economic capacity, but clearly what is the dominant currency bears some relationship to geopolitical power as well, right? And that's been the history of this, right? Okay, I'm going to move on now to a second configuration that's important to understanding, and that is if we look at inside the financial agents themselves, what do we look at when we see the banks and the structures of banks? How do we look at banks' balance sheets? Which is very important for understanding now what's occurring and the way banks work. We have to look, like any balance sheet, we have to see what assets they're holding and what liabilities they have. What assets they have and what liabilities they have. And again, we can develop particular facts or features of these balance sheets. The liabilities that banks get are, of course, their deposits. If they're commercial banks, right, their individual deposits or large investor deposits. We often divide these into demand, government, and other forms of deposits that they're holding. They also form long-term or hold long-term bonds.
How is a deposit a liability?
Because the
banks have to pay it back to you.
Yeah, plus interest.
Yeah, right. It's a liability for a bank because it's got to pay it back to you. Yeah, right. Long-term bonds. They'll also have government advances and loans. Government advances and loans. They'll also have deposits from other banks. Okay, they'll have deposits from other banks. They'll also have their foreign liabilities, which could just replicate all the same categories of their domestic liabilities. And then they'll have
what is that one?
Foreign liabilities.
I know, what is that?
Could be just the exact same thing here.
Oh, sorry.
Exact same thing. Could be they have the foreign branches, so it's the deposits they take there, it's the loans they get elsewhere, and so on. Okay, and then they have their own capital. And then on their asset side, banks will hold cash,
Should be an asset.
liquid
Capital.
assets.
Shouldn't that be an asset?
Okay.
No, this is their own capital that is basically that they have to pay back to their shareholders.
Oh, I see. It's a bookkeeping.
Yeah, it's a bookkeeping entry. Yeah. Yeah. They have their cash, their liquid assets, their loans that they've made, the securities that they've made, that they've purchased. Then they have what have become important today, special funds. That's what Tom was talking about in terms of when they securitize loans, they'll create a special fund or a special company. Okay. Then they'll have a range of other assets. And then again, they'll have their same foreign assets and the same structures of foreign intermediation to the extent that they're internationalized. So basically, you see when you have financial institutions, right, they have structures of liabilities here and assets here, which are all various forms, right, of money or fluid assets in various forms. And clearly, the objective for a bank, right, or any financial institution, right, is to borrow long and borrow with little risk, right? Borrow long and borrow with little risk, right? And relatively speaking, right, lend short and lend with higher risk. That's what's called leverage. That's what's called leverage. It has to do with partly what Tom was saying, their capacity given by the state to create money, and then their capacity to leverage their liabilities against the assets that they have. Okay? Now, critically, different forms of financial institutions, are less regulated in what they hold in liabilities and what they hold by assets. Right? Particularly, the states regulate mainly what are called primary banks. The Bank of Canada, say, will regulate particularly the Royal Bank of Canada, the Toronto Dominion Bank. The Federal Reserve will mainly regulate Citibank. Right? It doesn't even regulate the same thing as some of the companies, some of the banks in the U.S. that went bankrupt, like Bear Stearns or Lehman Brothers, which were called investment banks, aren't regulated in the same way, and they will have slightly different mixes of liabilities and assets, right, governing how they loan. Okay. Now, what's important, right, in this period, right, is how the leveraging of their assets, right, has evolved. And this is always what occurs in a bubble. Now, you can calculate that leverage either vis-a-vis different ways we can calculate it. We can calculate it by their own capital in relationship to these different assets, or we can relate it to the kind of very highly liquid assets like cash, right, or these money market funds, very liquid assets, against a range of others. Now, however we measure it, we tend to come up with this kind of ratio, that these were at ratios of, say, 5 to 1, right? Maybe in more risky banks who weren't primary banks, maybe 10 to 1. And now they went up to 30 to 1 or 40 to 1. Right? This is the classic register of a bubble, because it's got to find its anchor in financial institutions' balance sheets. Okay? So it has this shift, right, in the way that assets and liabilities correlate. Okay? Now, the entire period of neoliberalism from the 1980s to the present saw some movement of this ratio up. And then typically, at the point we're moving from just riskier forms of lending occurring by financial institutions, when you're moving into a bubble, you'll start seeing these ratios shift. We'll start seeing these ratios shift. They'll go from, say 10 to 1, and then they moved up to 15 to 1, and all of a sudden you'll see them double. Right? And all of a sudden they've gone to 30 to 1. Right? Now this is always, right, defended in terms of some typically new forms of financial intermediation which have replaced all others, and therefore banks can take on more risk. Right? This is the way that kind of all these new market models that are said to have gone and in computer modeling said the banks are better at handling how they relate their liabilities to their assets, and therefore can take on more financial risk. Now, the other thing it was doing is that we deregulated the financial markets, so those institutions started changing as well. Right? And we started getting some institutions, right, that were just being formed just to manage this balance sheet. Just to make these balance sheets look better. So, for example, if you had a lot of loans that were highly risky, right, in real estate, maybe you'll take them off, right, what we would call off balance sheet, right, remove them and spin them off to another company, and all of a sudden you've shifted your leverage ratios, right? And therefore it looks like you can keep lending, right? And you can keep lending as long as you can keep shifting these loans off to off balance sheet. So in other words, they're sitting in another company. Then the question is if you can find a group of suckers to buy those. Right? Well, maybe not always sucker, but at least other financial capitalists thinking that they can bear the risk of investing in those financial institutions.
Someone else who's won everything.
So you expand it out. Right? Yeah, Sandra?
So the relationship is of assets to liabilities, 5-to-1 assets to liabilities, or the other way around? 'Cause I
Well, you
assume
would
the
look
other
at
way
it.
around.
You'd look at it this way.
Yeah, yeah.
Yeah.
So why would you be wanting to spin off your assets? It would seem to me you'd be wanting to
Essentially, when you're
spin
doing
off
that,
your liabilities. Wouldn't you be?
because your assets are all dependent upon others paying you more or less, right?
Risky assets.
So they're riskier assets. So in other words, having more and more of them is more risk you're not going to be able to pay.
So
Well, they're not going to be able to beat your liabilities, right? Because these are going to collapse. So if you lose, say, on loans that you've made a lot, right? You've got a lot of assets, so these have shot up, but those loans are very risky. So it's brought it up from 5-to-1 to 15-to-1.
Right.
So it's very risky, right? So if you're not going to get paid, well, the way you think is these are matched by different things on the liability side, which means you're not going to be able to make some of the payments that you have in terms of liabilities. So you're basically trying to match these.
So
Most of the accountants in banks and stuff are monitoring these particular things, and they're monitoring the balances between these different components of the balance sheet.
So you're saying despite the fact that there were these claims that they manage higher ratios, like 30 to 40, banks are still trying to lower that ratio?
They lower it maybe by crafting new financial
Right.
instruments.
So even though these claims were being made, banks, it still didn't look good on paper, and they're trying to.
It's slightly, you would improve it looking on paper,
Right.
right? And as this was what Alan Greenspan said, he made a mistake. You spin them off, and he said, oh, it's okay, because they'll be self-regulated enough by the discipline of the market and being able to assess these spun-off corporations and being able to penetrate the amount of risk from those spun-off corporations back into the main
Right.
company that spun it off, right? But essentially, when you spin it off, you're reducing your leverage ratios here.
Right.
Then you, of
It's
course,
just creating problems.
yeah. And essentially, you've developed there was a whole range of fallacies in this, in terms of all kinds of statistical model fallacies, risk fallacies, and so on.
But when they sold them off, when they gave them those other companies, they made a percentage on them. I mean, they made money when they dumped it somewhere else, did they not?
Yep.
So
Sure.
that then went
They
over
do.
into what their cash.
They're still making money on it, but they're also sharing it out among others. So you're sharing out the money that you're supposedly making amongst others, and therefore the notion was you're not only sharing out the rewards, right? The logic is you're sharing out the risk, right? This is a classic fallacy of composition, right? Right? The risk could in fact increase, right? Because if any one of those partners that you shared it out with are fucked up, in fact, the risk is compounded because that person can pull it, right? Right? And now the risk is greater, right? Because you were dependent upon them, right? It's just it was based partly on a fallacy of composition, of looking at the parts and not seeing how the parts had to relate to the whole, right? And that's exactly what happens as soon as one starts pulling one out, right? It's then you begin the process of what we're living through now, right? Which is called deleveraging, right? So you've leveraged these ratios up, and you've leveraged them all in these spun-off corporations, right? And of course, when these spun-off corporations, what were called collateralized debt obligations or special investment vehicles, right? You're having to put them back on the balance sheet, right? And it's pure logic. If you're and just it's a reasonable way of thinking about the world. Right? If a company has obligations over here, those should also appear on their balance sheets over here. Right? So what starts happening is when those start becoming risky, obviously the regulators, etc., investors start saying, well, those are actually part of their asset structure and should be back on their balance sheets. Not only that, they should be marked down to the actual value they have. Right? What's called the mark-to-market rules, or what's called fair value accounting. Right? So they should be back on their balance sheets at the value. Now, if you're doing that, right, you've got problems with your leverage ratios. Right? And the people over here might be looking at those leverage ratios, and they're saying, this is too risky, I want to pull out. Right? Or others having to meet obligations because somebody's called payments. Right? So your assets start unwinding. Right? Right? Because somebody over here has pulled on your liabilities. So particularly what you'd be pulling is particularly your more liquid assets. Right? So you start developing this deleverage, which then can start locking up the lending between different sectors. You can start locking it up. And so the financial markets start freezing because of this deleveraging process. Everybody's having to deleverage. Nobody else is making any more loans. Okay, so it can start freezing up. Okay. Any questions about that?
So, just to clarify, so the banks want to keep the ratios low on paper, right? So that
No. No, they've got if they're low,
yeah.
you can't make any money. So it's like Adam was presenting, and Tom, right? To make money in the financial sector, you want to drive your ratios up. You want to be at the limit, and you want to keep pushing the limit. But the problem is that becomes then risk. So you then have got to draw it down. So you're pushed in one direction, right, to go up, more risk, right? Leverage more, right? Which means leverage more from a small amount of cash, a lot of loans. Right? That's how you make money.
That's all. Yeah.
Is it true in some countries they don't have to have any reserve?
Canada.
Yeah, zero ratio.
A lot of European too.
Canada and some European
I think
countries.
it's only US that has
Yeah.
a very little
Yeah.
reserve.
Yeah. Many of the European countries went off the reserve requirements. So this was another position of the neoliberals saying that the banks could regulate themselves adequately. They're in charge of their leverage ratios, so we don't need to have any kind of reserve requirements.
This is even the commercial banks?
In Canada?
In commercial banks.
Yeah.
I thought we had
Commercial banks have
reserve.
commercial banks don't have to have any reserve requirements.
Canada.
Canada. We removed them. Now there has been a push, as this was evolving, there was a push from the international agencies to move to new reserve requirements or capital requirements and expand them. We call the so-called the Basel Accords. But essentially, you know, this Canada's abolished it. A number of European countries have abolished it.
So just to clarify, they just basically wanted to continue to engage in high-risk money-making behavior while hiding it on paper, sort of, to encourage money streaming in, more loans and so forth. So the other people would continue to loan them.
There's clearly, as we're looking back in retrospect, there's clearly three things going on. One is the rational drive to expand, which Adam was speaking about, right? To keep pushing it, right? So that's a rational way you would kind of design that. A second reason is what Tom was speaking about. So you can leverage more, right, in your capital leverage ratios, right? And you're pushing it to some, based on, you know, as it's often called, right? You're developing a new company model or a new corporate model. It's a new way of doing things. So that's clearly what was going on. You've invented a new form, right? And in the financial market, remember, you're not inventing a new use value to be consumed, right? What you're inventing is a new form of financial intermediation, right? And sometimes they're successful, and sometimes they're disaster. If you want to do Italian history, maybe it comes up more on disasters than on successes, but that's what occurs, right? And so there's also that logic. And then thirdly, clearly, as we can see now, at the top of this, there's fraud going on. We know that at the top of periods of financial euphoria, every fraudster around wants to get involved. And clearly we can see as they're starting to look at some of the developments around these special investment vehicles and the collateralized debt obligations, there was aspects of some of the players being involved in that. You know, and particularly when you have Nobody's knowing the value of the instruments they're holding. Right? They can't get the value of them. The final thing I want to point on this is that it relates to also the Art raised earlier about geopolitical power. Right? This development's also represented during the last 30 years the geopolitical power of the U.S. That is, the U.S. expanded this particular system, right? And then this system started spreading in other parts of the world, and with the U.S. dominance over the world's financial institutions, and many of the European and the Asian banking structures being embedded in the same level of development and the same logic, also wanted to start adopting a range of these. So this started spreading around the world, but the key initiator is the U.S. So this was also a successful means, as I'll show in a minute, for the U.S. to dump its risk onto the world. Right? It dumped its risk and all this liability structure partly on the world. So these are partly American financial institutions becoming especially more highly leveraged. Right? They're getting and dumping a range of their off-balance sheet items onto the rest of the world. Right? So that's part of kind of the way that these financial institutions then start, getting in this whole hierarchy of the relationships, of the hierarchy of money I was pointing out, and the hierarchy of the markets. They start spinning into each other.
That's where they left the gold standard?
No, that was a long time ago. That was a long time ago. But I'll get to a point around this in a minute.
Neoliberal.
Yeah, neoliberal allows it to expand. Okay, so any questions about this there?
So the U.S. kind of fool the rest of the world like Iceland and stuff?
No, being probably the only person of Icelandic background. Icelanders are their own fools. That is, their banks were very much committed to internationalizing in a particular kind of way, and they are a very small place that saw a niche, in the spaces in the European forms of financial intermediation to take advantage of the American structures of bank, and then they became dominated by a very neoliberal government who moved strongly in that direction. So they're also the makers of their own disaster.
Same thing about South Korea too?
It's a little bit different in South Korea because of the nature of their financial markets and the pressures from the Americans. They both have the own dynamic of the Korean ruling classes wanting to internationalize, but also the dynamic of the Americans' control over and influence over Korea, pushing them to free up their capital markets in a particular way, adopting the North American model. Okay. I want to move on to another point now. Also looking at then how these leverages, link to the international dimension, to how it intersected with the international level. Now, when we look at places or countries, we often try to find out the net relationship of savings and investment, consumption and investment relative to savings. And what we look at is often what we call personal balances, corporate balances, government balances, external balances. And we try to figure out, are these net debtors or net debtor or net creditor relations? And we try to assess how this correlates to the international market and the flows that start occurring between countries. We can take this in terms of the basic relationship with what we look at in terms of government balances, that is, whether governments are systematically borrowing or lending, plus personal balances, what we can break down into corporate balances plus household balances. And then those will become linked to what we call the external balance, or their current account of the balance of payments. That is how much, it gets to how much we're having to borrow on a national basis. When we look at different parts of the world, and in this period we can get a different relationship between government balances, corporate balances, household balances, and then how that's been linked to external balances. We can take the US case. Okay. We know that government balances have been strongly negative, particularly over the last 10 years. There was periods where the US government was in surplus in the late 90s, but for the most part it's been negative. Right? Corporate balances, right, were negative, but we know that they've largely been positive over the last period. Okay? And we know household balances have been negative. And it's a combination of household balances and government balances in the US are massively weighing out the surpluses in corporate balances, which means the US external balance is negative, which means they're having to borrow from the rest of the world. They're having to borrow from the rest of the world. Now the household balances, right? And we'll see from other parts of the world tend to be negative too. That's particularly because what we know has been a feature of neoliberalism. That is, neoliberalism has been compressing wages, right? And as a compensation for that, people have become more in debt, right? Whether it's around mortgages or consumer debt and so on, right? People have become more in debt. Okay? So household balances have become negative. Now what's key to bubbles, or this bubble, right, is household balances in the US went extremely negative. Right? And that we also know is a feature of neoliberalism over the last period. That is, the working class in the US has been tremendously defeated, pushed down, right? Going back to the Reagan strikes, breaking of the PATCO strike in the Reagan period in the early 1980s. So working class wages in the US have basically been stagnant, right, over this entire past 25, 30 years. Right? And people have been maintaining their living standards partly by going into debt. That's both living standards in a direct sense, that is just maintaining the same kind of basket, but also we know that income levels and poverty levels are always relative, but also to stay relatively up, right? People have been doing that by going more and more in debt. Okay. And clearly, the deficit here has been partly the basis for the surplus here, for the reestablishment of corporate balances. That is, the corporations being in surplus and relatively earning more profits. Now, maybe this is not as high as other periods. Maybe it's had cyclical basis. Maybe it's not leading to high rates of accumulation being thrown back in. But relatively speaking, corporate balances have been restored, right? And they aren't the critical factor in borrowing, right? In the US, it's the government balances and household balances. If we look at the European Union, to some extent it's a saw-off, right? Some in surplus, some in deficit. Corporate balances in Europe have also been positive, and household balances to some extent in Europe have also been negative, just not to the degree of the US. And when we sum all these up, the external balance of Europe has been positive, which when we break it down, that's been particularly based on Germany. Right? A little bit other cases, but particularly based on Germany. And then when we look at the other key actor, East Asia, we could collapse the key Gulf states in this as well. Right? Right. In East Asia, to some extent also, government balances have been sawed off. That is sometimes in deficit and sometimes surplus. The Japanese often been in deficit, other countries been in surplus, but relatively sawed off. Corporate balances have been extremely high. Okay? Corporate balances have been extremely high. Look at what's happening between the corporate sector and profits, what's happening to workers and their incomes, and how that spills over into credit relations as a whole. Right? Because it has different dimensions for credit relations for governments, workers, corporations. Okay? Now, the other dimension that we should look at is then how this all configures in terms of the stylized features of the balance of payments. If we look at the balance of payments are constituted by a current account, right, which we can divide into trade and what we call invisibles, which is flows of profit, income, and interest. Okay. Then we can also look at the capital account, which we can then divide into flows of portfolio capital and foreign direct investment. Portfolio capital meaning bonds and other forms of shorter-term capital. We can then look at the U.S. and to some extent the rest of the world. The U.S. has been negative on trade. It was positive on invisibles, that is, U.S. investments around the world were earning income, right? That was then flowing back into the U.S. This is now deficit as well, which of course then means that the U.S. current account is in deficit. The rest of the world on trade, right, following from this, has been in surplus. On invisibles, it was negative and now is positive. That is earning income on investments. Right? So in other words, is deeply positive on current account, which means that the imbalances on current account, which are tracking these external imbalances, then have to be registered in capital flows. Okay? They have to be registered in capital flows coming back. Okay? The capital account for the U.S., right? Because it's in deficit here, and this is an accounting relationship, right? To balance out, it's got to be positive on the capital account. In other words, they have consumed more and are indebted, and to pay for it, they have to have money coming back in. Okay? So this is essentially portfolio capital coming back in, which has been positive, and foreign companies starting to extensively invest in the U.S. So that's also positive. Right? And clearly, with the rest of the world being in surplus here, right, they've got to be lending back. Okay? So they have been lending on both portfolio capital and investing in the U.S., so they're running negative there. Okay? So in other words, right, you have balance of payments or accounting identity, which have got to summarize all these flows. So they've got to all balance out. Okay? And they're reflecting these forms of imbalances on consumption, investment over savings. Okay? The U.S. is consuming more. Right? The U.S. is massively consuming more. So it is negative on current account. Right? And therefore, to cover its imports, it's got to be borrowing capital. So it's borrowing tons on portfolio capital and also borrowing in the sense of foreign direct investment coming in. The rest of the world, and then particularly as we broke it down, East Asia, and then secondly we would be looking at the Gulf states and Europe, right, are running larger current account surpluses, which then they're the countries or zones which are lending back to the U.S., particularly portfolio capital and foreign direct investment. Okay? 1 second. Okay. Now, this has been the structural relationship here, and to some extent here, with some variation since the 1980s. Okay? Since the 1980s. And the different phases of neoliberalism has meant even while the U.S. was accumulating more quickly, and it was growing more quickly than other parts of the world, and consuming more, this was growing at the same time. So clearly what you had is an underlying contradiction internal to neoliberalism, okay, that is, linking the world economy and is extremely dependent upon financial intermediation. That is taking place by those bank balance sheets inside each country and then the flows between them. So in other words, right, bank balance sheets are partly blowing up in relationship to those mismatches, which have been in place for almost 30 years, right? And then they're affected this hierarchy of money, right? Which is also blowing up, and the financial instruments growing to cope with this are also getting more complex and larger, right? So you have then the conditions for which financial bubbles will erupt, or will develop, and then you're asking what's going to cause them to trigger. Okay? We have the pure credit money system, right? Becoming unhinged, right? Flexible exchange rates, more deeply linked markets, balance sheets becoming more leveraged, right? And those leverages intersecting with the way the world market is working, so that these are expanding and expanding and expanding. And then especially the reaction to 9/11 and the events surrounding that, right? The sharp drop in the stock market after a bit of a crisis a couple years before, right? An intense lowering of American interest rates, which start affecting this entire hierarchy, right? American interest rates turn negative, right? Which means that people are looking to leverage their assets in more riskier investment, right? And, right, these flows being in place and the Americans not giving a shit about these imbalances because they've got to fund the war. And basically, as part of this conservative, they're attacking American workers even more, right? So they're suppressing wages even more in this cycle, right? So you're ballooning it up even more, right?
And the American workers aren't fighting back.
And they're not fighting back, and they've adopted American imperialist ideology as well, and therefore undermining their own conditions.
Yeah.
Sorry, Nadia.
I just wanted to clarify by rest of the world, you meant rest of the industrialized world or newly emerging. I mean, presumably
This
the
is in
majority
fact.
of the rest of the world are borrowers.
It's in fact become a little complex. The rest of the world, you're absolutely right to ask for further clarification. The rest of the world in the first instance means the key East Asian countries. Japan in the early phases of neoliberalism, then in the more intermediate phases of neoliberalism, South Korea became important, and a range of the other so-called NICs. In the third phase, also China. The Gulf state, the Gulf, and Europe, all for this period, meaning the European Union. Also the Gulf states, particularly when oil is high. Now, the way it's actually worked out, to some extent, in this period, the structures of finance in the last phase of neoliberalism also have other parts of the developing country, world, in the same process, more or less funding American consumption structures and sending capital into the US rather than being used for their own development. Now this takes different place. Sometimes it's because of debt, existing debt loads and the payment for that debt, right? So you're having to run current account surpluses to send money back to pay for past borrowings. Some cases it's just the way that the class structures have evolved, right? So it's a little bit different in the phases. But to some extent, in the last phase of this, the whole rest of the world is funding this structure. But you'd have to have a bit of sensitivity to time period in place. Somebody else? Yeah.
So, the Canadian example, we owe about $500 or $600 billion.
I can't remember the exact breakdown. Does anybody know the exact breakdown of Canadian government debt? Who holds it? I can't remember. More or less, the features have been some sort of split, about half and half. Half of it is domestic, half of it is international markets, typically New York.
But when we say domestic, who is it domestic? Because when
capitalist classes here.
When it was true,
it would be the banks and the financial, different kinds of financial markets and trusts, etc. And you decompose it, it ends up being the 5 or 10% of the capitalist class. So the fundamental characteristic of the redistribution of income under this period of neoliberalism, especially in Canada, has been the paying down of debt. And the paying down of debt particularly means then a transfer of wealth to the highest income earners. We could have paid that debt down also by taxing the same people. So pay them on one hand, take from them on one hand, and pay them on the other. We decided to take from the working class hand and pay to those that had the most. That's the way we structured it, because we cut their taxes at the same time while shifting taxes onto workers' incomes in different forms. Yep.
So wage compression, you mean the decline of the real wage
Yep.
after inflation?
Yep.
Yeah. Productivity has increased dramatically
Both.
in the last 10 years, but the real wages
Yeah.
have collapsed.
I'm meaning both. I'm meaning both.
That has contributed to the...
Exactly.
separate,
So people have become more indebted. Right? So this is what fuels it right at the international level
This
as well.
makes people dependent upon financial markets to be able to
Exactly.
keep consumption rather than...
So I just now need to put in then how this relates to wider loan structures. And I want to deal with it then looking at it in terms of specific markets. Now, in fact, what we're dealing with in this structure is not one bubble, but at least 5 bubbles. Okay? That's what's making this so complex and enduring. We're not dealing with one bubble, but at least 5 bubbles. We have had in this structure the new economy and the securities bubble. Right? Now, the new economy, of course, was the development that occurred in the late 90s. But to some extent, we've had a bubble in security markets as a whole. That's partly because if we go this way, we're dealing with more risk going this way and more risk going this way. Okay. And when you're initially looking for higher returns, equities be more risky than federal government treasury bills or federal government loans, borrowing from the government. Right? And therefore, you would put money in there because the returns are higher. Right? So there's been a huge amount of money that's went into stock markets. So we've had a securities bubble. Secondly, right, from the structures I just mentioned, we also have a consumer debt bubble. Okay, a consumer debt bubble. Now the securities bubble, right, has partly been coming down in different stages, but as you can see from the stock market coming down now, you're still dealing with the deflating of that securities bubble. Okay? The household debt bubble, right, the loans bubble, hasn't been hit, right? But we know that people, right, are highly leveraged, and again, depending upon classes, we see people more highly leveraged. That is, it doesn't. If you have very, very low income, right, it doesn't take very much to be highly leveraged in terms of having debts relative to your income flow. Okay. Now, all social classes to some extent have become highly leveraged, though. About that debt bubble, which is another example where banks and other financial institutions have shuffled off, right, personal debt loads off into these other corporations. Right? We don't know the state of the special investment vehicles related to consumer loans. They haven't been pricked yet. Right? Mainly because we haven't had the sticking in of the recession, so unemployment rising, right? So workers have less capacity to pay their personal loans. And it's just starting to fully spill over into the corporate sector, so the ruling classes and professional classes that have also borrowed highly are only starting to not be able to meet their consumer debt. So what's going to happen when that starts spilling over could also affect kind of things that have to be put back on primary lenders' balance sheets, because these special investment vehicles, again, can't handle the loans. Right? They're basically frozen up. We don't know what's going to happen there. Right? And that's partly their own credit companies that they've spun off, right? Their own credit card loan companies, and so on. Right now, as you can see, anybody who has a credit card knows that they're starting to hit you by more fees and higher rates. Right? Some of them are jacking up their rates by 10%. They're really getting into usury. Right? They've moved from 17, 18% now up to 28 to 30%. Right? And this is, really starting to bite. But this bubble hasn't been pricked yet. Okay? The third bubble, which is clearly hitting Canada very importantly, is the commodities bubble. Okay? The commodities bubble. Right? And that is, right, when securities started going down, or certain sectors of security, certain tranches of securities, and you're wanting to then have high returns, right? And oil prices and a structural and a conjunctural food crisis are there, right? You then see commodity prices surging, right? And there more and more people put money into commodities markets, right? And we now see that a commodities bubble is coming down. That is, the future markets and the price shares for commodity companies is coming down, and we're living through right now. Every day, more or less, you hear reports of how that bubble is coming down, and clearly that's affecting Canada. And we know in Canada it particularly affects northern and western and eastern Canada very heavily. And you can see, particularly in Alberta, kind of the transformation that will be occurring in the tar sands and a whole range of other stuff as the commodity sector unwinds. That we're just in the middle of. Over the last few days, the fourth bubble has been unwinding, and that is what's called the yen carry trade bubble. Okay, it's a complex term, but it's relatively simple to relate. The yen carry trade simply means, right, when the Japanese had a big bubble in the early 90s, and that came down, okay, they had negative interest rates, right? Negative interest rates. In real terms, right? Well, they can't turn a negative, but in the discounting and inflation, right? So you basically can borrow in yen for nothing, right? So you borrow in yen, and you carry the yen to another currency. Right? Now, as long as that other currency has assets, right, in the structure that is paying something, and then it's also a currency that you're expecting to go up relative to the yen. So the key example would be the Australian dollar, right, where interest rates in Australia were relatively high compared to other places, and the Australian dollar's going up because of the commodities boom, right? You're earning tons of money by borrowing for nothing in yen, right, and converting it into Australian dollars, and then whenever you want to get out of it, right, you just sell your Australian dollars, right, and pay back your yen loan, and the difference, you've made a lot of money. Okay? That bubble is now starting to unwind, right, because people have to make, different financial institutions have to pay off their liabilities, right, that people are demanding their deposit. They're having to sell off their yen carry trade assets, right? This is particularly hedge funds, right, who were borrowing in yen and then putting it in other currencies. That is becoming unwound, and therefore you see a lot of currencies dropping, and then the yen rising, because they're having to pay back their yen loans. Right? It really means, in a sense, that both the yen and the American dollar are rising, because they're unwinding their positions in yen and taking up yen and, unwinding their positions in third currencies, and then returning the yen and either keeping it in yen or putting it in American dollars. So both are rising in turn. That's just started over the last week or two. And that's because the hedge funds are starting to get hit, and they're having to unwind their positions. The final one is the one that we've been talking about, mainly that triggered this prior crisis, and that is the real estate bubble. Okay, that proved to be the trigger of all these. In any case, anytime you have a bubble, one sector, one actor proves to be the trigger. And that is, again, the real estate bubble, which I just want to show how it works. You had borrowers, right, who Adam described as the ninja borrowers. In other words, high risk, no income, no job, no assets. Borrowers, high risk. Right? And which was fed by the changes in financial market changes. Also fed by government housing policy changes. That is, government housing is no longer building public housing. It's all dependent upon the private market. And then there were regulatory changes. Which then had linkages to the mortgage lenders. Linkages to the mortgage lenders, which were a mix of banks, governments, government agencies, also particular mortgage brokers. And then, again, with financial deregulation, you had a range of new high-risk mortgage brokers. So you, in other words, you had not only standard mortgage lenders, but you had a range of additional mortgage lenders going into more high-risk lending. And all these changes also changed the lending structures of the main traditional mortgage lenders. This led to a loop between here and here. That is asset speculation. New, higher, seeking out of higher returns. Now, asset speculation in two senses, right? People were trying to get housing, and they were speculating on their capacity to pay, the capacity of their house values to keep rising, and people were partly being pushed in that because there isn't any other housing that's being built. Right? So it's being fed partly from this angle, and it's being fed by the mortgage lenders. Okay. You then have the mortgage lenders developing special investment vehicles to take their loans off their balance sheets, right? So they could loan more and put them in these special investment vehicles, which were forms of what are called, became forms of what are called collateralized, or what they were selling was collateralized debt obligations. Collateralized debt obligations meaning debt, mortgage debt, that had collateral, housing, obligations, a loan. This is what Tom pointed out is called the securitization of credit. And it's called the securitization of credit because you're spinning it off into a special investment vehicle. In other words, another corporation that you've made up, right, that allows you to take some of your assets off your balance sheet, right, which means you've deleveraged as a financial institution, right, and you put it on an off-balance sheet. And it's securitized because you then have a range of other people who purchased it. You've had hedge funds purchase it. You've had pension funds purchase it. You've had other banks purchase it. You've had insurance, as we know, insurance agencies purchase this. Who else? Mutual funds. So in other words, the whole range of financial institutions, right, ended up purchasing these structured investment vehicles, right? And that's then known as the securitization of credit, which was supposed to mean risk was decreasing, but it's like this hand is lending to this hand as if they aren't linked, right? And in fact, we even see that the investment vehicles on the one hand are the same as on the other hand, right? So in fact, risk wasn't being decreased, it was being compounded, right? Because in fact, you're just lending to the same actors in many ways. And of course, the risk is increased because if any of these actors fail, the whole thing could uncouple rather than being spread more, right? Now, the other thing, the final thing that became important, is these aren't just US based, but the US managed to dump these also on the whole rest of the world, right? So it's also the rest of the world purchasing them, and their financial institutions, et cetera, et cetera. So in other words, all these start having claims, right, partly in this real estate market. Now, just take what happens. The structure imbalance is in place, right? And because of geopolitics, because of the dynamics in East Asia not being able to shift its class structures and its externally based form of development, develops this reciprocal relationship with the U.S. The U.S. in turn has these imbalances in these class structures, right? This is locked in, right? So you keep lending to the U.S., right? And you're lending to the U.S. in treasury bills, some corporate paper, and the U.S. pushes interest rates down to negative territory, right? It was what the so-called Greenspan put, it was called, meaning he was putting out there, right, new debt instruments at very low levels to underwrite another boom. Right? So if you're a foreign borrower, you're not going to be happy with that. No returns. The Americans were blocking in different ways various purchases of companies. But besides that, you have a security bubble, so it means, relatively speaking, companies are expensive to buy. What becomes most attractive is these special investment vehicles, which are paying high returns, right? And the security agencies, the rating agencies, the accounting standards boards, the regulatory agencies are all saying, these are very good instruments, right? They're rating them AAA. In other words, the highest rating you can get, saying they're risk-free. Right? And of course, when something starts happening here, right? Workers are already in a tough situation because of, right, long-term wage compression, right? Further slowdowns in the economy disrupt borrowers here, right? And they can't making their loans, right? And clearly, when they can't start making their loan payments, right? When they can't start making, this starts collapsing, this starts collapsing, right? And then banks have to begin this process of deleveraging, which then starts rippling over into all these other financial institutions and all the dimensions over the hierarchy of money. So you then enter in this spiral, right, that initiates here, but triggers into all those other bubbles, which are linked to these forms of intermediation and how they've changed. Right? You can see now we've moved from one bubble to another bubble unwinding, right? And the deleveraging process keeps going. And then you can see what becomes a critical point is that the money dealing capital, right, when you're in a bubble, is refusing to deal with each other. That is, they're refusing to loan to each other. Which means then the credit markets are locked because the banks don't trust each other and they don't trust each other's balance sheets. Right? And clearly that's the stage we're in now, with it being unclear how much further this will unwind and the consequences. Why it's a big question is because it also relates to geopolitics. And geopolitics has yet to shift. And so the structural forms of this, funding this, are still in place. And the class structures and the class struggles are not yet challenging the way that the asset bubbles are being unwound. Right? So we're at this political moment, right, where the question of alternatives is central. And the main thing that we see is these alternatives, right, are basically asking for the same structure to be maintained. Right? The first attempt is to reconstruct neoliberalism and have the working classes pay for it. And then the second thing is have the East Asians and the rest of the world also keep paying for North American forms of development, North American capitalism. I'll take 5 minutes and then we'll break and then we'll be on time for the alternatives questions. So, Carol? Not particularly. There's lots of theorists of the ruling class attempting to come up with
Yes,
strategies
they
right
are.
now. That's basically where we're at. And the difficulty of the balance of class struggle right now is not opening up a lot of spaces yet for alternatives, except in particular countries, which we'll get to in a second. Yeah. The overall composition of taxes, right? They reduce corporate taxes, and they also at the same time reduce personal taxes, and then they add mainly forms of value-added taxes and raised those up, and then they added a lot of user fees. And then, of course, in Canada in particular, and the US, we then cut program spending at the same time. So you could shift tax balances and shift overall tax volumes, and use that also as a vehicle to restore corporate profitability. So they were tied together. And then, obviously, clearly, the ruling classes have been relatively successful in pushing that ideology. I should take art in the 1930s. Clearly, because of the stage we're at, it has not outstripped the 1930s in terms of growth levels and accumulations. The potential that we're at now is that it will keep seizing up all kinds of investment as well as people's personal consumption patterns. Workers spend all they get, so this is also what's flowing to workers.
Yep.
And it also depends upon what the capitalists are doing in consumption, but also whether their investment. We're clearly at a point in time where that's what's occurring. Those investments are starting to seize up, and those consumption patterns are starting to seize up. So there's no doubt that you've entered a phase of recession. The question was whether it'll keep spilling over. Now the thing is, we'll come to that just after we break. The thing is now there's also enough knowledge that was different in the 30s about responses to it. So there's a question of also whether those responses will be successful. But clearly this is a huge crisis that can only really compare in the advanced capitalist countries to the 1930s. Clearly other countries of the world have gone through crises more severe. But that's on an individual basis. We should just take one more question and then break and then come back to which will be more general discussion in the 30s. Because you have one credit mounting on another credit. And you have that building up. Now, Adam and Tom pointed out in the beginning session that this all has to relate to the actual value produced. So to some extent, it's underpinned by that question, right? The value has to be produced. So in some senses, workers will pay for it. The question is whether we'll pay for it on our terms or it will be on the capitalist part. Let's take 5 to 10 minutes, and then we have about 45 minutes to wrap up with the discussion.